Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Today we will review what happened last month in September, how our portfolios performed, and kind of where the economy is at, and a little bit of an update or outlook as to what we see happening in the next couple months. Cameron, why don't you kick us off with some economic updates?
Thank you, Kelly. Good afternoon, everybody. Hope everybody's well out there. I'm going to talk about some numbers we don't often talk about because I think they paint kind of a picture of what we're seeing from an overall economic standpoint. Obviously, the markets have been down significantly last several trading days. I think there's a lot of consternation, unease out there. You can kind of feel it when you talk to people. So let's jump into a couple of numbers. On September 26th, the Commerce Department reported that new home sales fell 8.7% to an annual rate of 675,000 in August, from a revised 739,000 in July. Issues cited, obviously, higher interest rates and record home prices, led to that decrease. That is more of a leading economic indicator. New home sales are kind of a fair predictor of where the economy, where consumer sentiment is overall. Speaking of consumer sentiment, consumer confidence. Also on September 26th, the Conference Board reported that its confidence index dropped for the second straight month to 103. This was lower than the 105.5 that it was expected by analysts, and it's significantly down from the peak post-pandemic high of 128.9 in June 2021. Again, consumers continue to struggle with high inflation, high interest rates, and recession fears. One thing we talked a lot about during the pandemic and post-pandemic was the amount of savings. Approximately $1 trillion of savings went into consumers' savings accounts while they were not out spending. And unfortunately, if you look at the numbers today, Bloomberg reported on September 25th that the richest 20% of Americans still have excess savings from the pandemic. The other 80% have already spent down to below pre-pandemic levels. So we're now seeing savings rates and overall savings below where we were at the pandemic. This has far-reaching implications, especially for the jobs market. We know that hospitality, construction, even manufacturing, there's been a struggle kind of for entry-level workers. These are people that put a lot of money in their pockets during the COVID pandemic. And, now that money's been spent down. So are we going to see a resumption of, significant job growth in those areas for entry-type level employees? Another interesting number, office vacancies. On September 27th, the National Association of Realtors reported that office vacancies in August hit an all-time high of 13.3%. And what's interesting about office vacancies is many states get up to 40% of their revenue in real estate taxes from commercial and office tenants. So that can have big implications for state budgets. Let's talk about just kind of the inflation numbers. Again, we've got three that have come out recently. The Consumer Price Index. On September 13th, the Bureau of Labor Statistics reported that the Consumer Price Index rose 0.6% in August. This is up after a mild increase of 0.2% in July. And over the last 12 months, the index now is up 3.7%. So again, very, very much away from the Fed's stated goal of 2% inflation. Continuing on the inflation front, the Producer Price Index. On September 14th, the Bureau of Labor Statistics reported the Producer Price Index increased 0.7% in August. This is compared to 0.4% increase in July of this year. The August advance is the largest increase since 0.9% in June of 22. One more number, Personal Consumption Expenditure Index. The Bureau of Economic Analysis reported on September 29th that the Personal Consumption Expenditure Index increased 0.4% in August versus 0.2% in July. So yet again, we're seeing that while we thought maybe we had a cooling of inflation, we're starting to see it tick back up. A lot of this inflation can be attributed to energy prices. The price of oil per barrel has been up significantly over the last several months. We've seen it cooling the last couple of days. But by and large, if you look outside of just GDP and employment, the rest of the economy feels soft. It feels like we're moving in a soft direction, whether that's a soft landing or a recession. We don't know, but the numbers are certainly panning out that the Fed's work to fight inflation is certainly taking the foot off the gas pedal of the U.S. economy. Consumers are feeling it. Businesses are seeing it, in office vacancies, in consumer confidence, in the amount of expected commercial defaults as higher interest or as lower interest rate loans now have to be refinanced with higher interest rate loans. Things don't feel great right now, Kelly.
I agree. Basically, that's reflecting the softness or the weakening of the economy that has been happening. The expectation is we probably still have a ways to go from a weakening standpoint. Inflation, we talked about a couple months ago that the lower inflation numbers were probably a little bit of a false signal back in the summertime. The reality, we're at 3.7 now. At the end of the year, to be in the high threes, low fours inflation-wise is probably realistic. That means the Fed's not going to reduce interest rates anytime soon. Potentially more rate hikes coming. What we have seen, though, the last couple times they've raised interest rates, we haven't seen the short-term T-bill rates go up. So they've actually come down a little bit, which means the bond market is, at least on the short end, is assuming that short-term rates, in the way the bond market's priced in, short-term rates for bonds have probably peaked out or about close to the peak now. But what we continue to see is, or the reality setting in, that we're probably in a higher inflationary environment moving forward. Yep. No longer a 2% environment, probably more like a 3% environment. And we've seen longer-term bonds, especially like the 10-year Treasury now 4.7%. You know, that's been a pretty big move just in the last month or so, which has had impact on a lot of different bond mutual funds. Fortunately, our clients, we've been staying short, so we haven't felt that pain, but you're starting to see some pain out there in, you know, with a lot of individuals who are in longer term bond funds. That's going to continue to happen. That's kind of where we're at with the long-term bonds. And there could be more upside with long-term rates is kind of my thought process.
Short of a major dislocation in the economy, do you see interest? I mean, the conventional wisdom 2 months ago was probably one more Fed rate increase this year, and then maybe even see rate cuts next year. I think that argument kind of is out the window. I don't know if there's one more rate increase this year. Hopefully there's not. I would like to see this play through the economy. But certainly to your point, we are in a new interest rate environment. I don't know how long it's going to last, but 2%, I can't see us getting there anytime soon. There are too many underlying issues that are, you know, really forcing us to this new regime.
It's a new environment we haven't seen for, 12 years, 15 years. I think we're going back to more normalized interest rates where 5% on the 10-year Treasury is kind of normal. Mm-hmm. So I could see, if the Fed cuts rates, it's going to be on the short end. I think the longer-term bonds stay elevated in that 4 to 5% range for the 10-year, okay, which means mortgage rates in that 7% range, high 6s, 7s, I think is a reality moving forward. That kind of that changes the housing dynamic a little bit. New home sales were down. Second homes, but new home sales, that's, the reality there is there's a lot of supply constraint. There's not enough building. There hasn't been enough building going on for new home sales. Then you also have the fact that the average mortgage rate in the U.S. is like 3.6%. So in existing home sales, somebody selling their existing home, those not a lot of activity there, because why would you walk away from a 2.5%, 3%, 3.5% mortgage? So you're seeing activity slow down, but the reality is demand is there for housing. You have the millennials are forming families, have families, they want houses. They don't want to live in the basement anymore. They don't want to live in apartments. So, housing demand is still going to be there. It's just, it's supply constrained. You have issues with higher rates, but we'll get through it. I mean, with a softening economy, it's not going to be the end of the world. Yeah. Certain industries are definitely going to be getting hurt and are going to continue to be hurt. But in general, this has kind of been a long slog, especially, these last, call it 12, 15 months. It's going to drag on for a little bit, but in hindsight, it'll be another blip on the radar. Yeah. It's going to be interesting to see how earnings come in this quarter. Some people think that earnings may have bottomed out, or we're going to see the lows in earnings this quarter potentially. That bodes well, more intermediate term, longer term for the stock market. But right now, the market, we're definitely in correction mode right now. Speaking of which,
and we're certainly reaping what we sow in terms of printing money and easy monetary policy.
Right, and
too far, too fast.
Obviously, that's the lower 80% of the population, the COVID money is about gone or is gone. The other reality is with all the fiscal stuff that's been done, and that's where, you see a lot of things softening, but then again, the other side of the coin is a lot of that money that was committed by Congress hasn't been spent yet. So
they'll find a way to spend it.
Well, you're going to see a shift where a lot of the infrastructure spending, that stuff's still coming. So there's still a lot of money that's going to be flowing into the economy. So it's not like the economy's going to fall off a cliff. It's just, not all boats are going to be rising, that's for sure.
Yeah.
So that's kind of where we're at. And when we talk about the markets, so last month, pretty ugly month. For September, the S&P was down 5.04%. The Dow Jones was down 3.82%. NASDAQ down 5.79%. Small cap stocks measured by the Russell 2000 down 7.07%. Internationally, the EAFE, which is developed world, down 3.46%. And emerging markets down 3.34%. So that was the month of September. Step back on so far this year, year to date, S&P is still up 11.68%. The Dow only up 1.09%. NASDAQ still up 26.3%. The small cap stocks, as measured by the Russell 2000, up 1.35%. Internationally developed world, the EFA up 4.49%. Emerging markets down 0.38%. So still ahead of the game for the year. We've given some back. Was a rough month. The next month or so, I think we at least have a couple more weeks left kind of in this correction phase. There's a lot of seasonality where August and September are typically the weakest months. We've gotten through those. Maybe some more bumps along the road in October. I would think we probably, come out with more of a positive path into the end of the year. How our portfolios performed, growth of income for September, we're down 3.2%. Year to date was still up 4.7%. We did have some things made money last month. CVS up 7%, Exxon up 5.75%. Toyota up 4.4%, so we did make some money in some stocks, but there were some laggards in September. Raytheon down 16.4%, Nvidia gave up 12%, Nucor and Apple were down 9%. Year to date, Nvidia still up 198%, Apple still up 32%. Talking about home build, the housing market, Lennar still up 25%, Nucor still up 20%. Raytheon's given us, pain year to date, down 27%. CVS, even with a 7% bump this month, still down 23%. Nike's down 17% year to date. In our dividend yield portfolio, which is really, think of it as defensive, conservative, large dividend paying stocks. Tough September, down 4.3% year to date, up just under 1% at 0.8%. Gainers there, Packaging Corp America up 3.9%, Blackstone up 0.72%. 3M during the month gave up 12%, US Bank down 8%, Eaton Corp down 7.4%. Year to date, Blackstone's still up 48%, Eaton's up 38%, Packaging Corp still up 23.4%. Our appreciation with income portfolio, probably the best, of our portfolios, performed the best, only down 2.2% for the month. Year to date, only up 1%. So kind of a different mix of, we have some energy in there, we have some financials in there. Dell up 22% for the month, Energy Transfer Partners up 4.2%, Shell up 3.7%. General Digital down 12% for the 12.75% for the month, Broadcom down 9.5%. Year to date, Dell up 75%, Broadcom, even though we get up 9.5% for the month, still up 51%. Energy Transfer Partners up 27%, Shell up 16%. So energy's working. A lot of stuff's not working. American Tower down 21% year to date. Gilead down 10.2% for the year to date. Price Potential down 3.5% for the month. Year to date, we're up 5%. So, having a halfway decent year to date. Big gainers, Centene up 11.7% for the month. Arch Capital Group up 3.7%. Big laggards, Nice down 12.7%. We actually sold out of that on Monday. Quaker Houghton down 9.9%. Year to date, still in the portfolio. Intuit's up 32%. Fiserv up 11.8%. Visa up 11.4%. downside in the portfolio is we're still holding Genpact down 20, Juniper down 11. Small caps, our small cap portfolio definitely solid better than the index, down 3.7 for the month versus 7% of the index for the index. Year to date, we're up 2. The index is only up the index is only up about 1. So small caps, hanging in there for the month. Alpha Metallurgical Resources up 28%. Duolingo up 12%, Consolidated Water up 7.2. Laggers this month, Azure Software up down 25%. We actually sold that yesterday. Schrodinger down 23%. Progress Software down 13.6. Year to date, Powell Industries up 139%, still in there. Performed Line Products up 96%, still in there. Consolidated Water up 95%. So we have some big gainers in there. Laggards that we still have in the portfolio, really our biggest laggards down 17%. The rest of the losers we walked away from. So that's kind of where we're at. Like I said, it could be, I think we're towards the end of this correction phase, maybe a couple more weeks. I think we start regaining ground by the end of the year. It's going to seem like time's going to drag on, but we will get through this. And, once we get through the correction, if there is a recession through that, I think we're going to be fundamentally in a better spot as we move forward. For clients in a higher interest rate environment, that makes from portfolio management standpoint, we can actually start
get some
parking.
yield.
We can park safe money and get 5, 6, 7%. That's going to be great. That helps us, kind of hit our bogeys so that, clients can, get the returns they need without having to rely strictly on the stock market. So, all in all, it's going to be I would say a choppy end of the year, maybe some strength towards the very end. But in general, we have to kind of keep plodding along.
Yeah. And obviously, we're here for you, our clients. If you have any questions, if you do have some concern, if there is a little bit of anxiety, feel free to reach out to your advisor, reach out to Kelly or I. We're always here for you. We're always here to answer questions, tell you what we're seeing, tell you how we're managing the portfolios to minimize the risk, try to maximize the returns. Mostly we appreciate the trust. We're here working hard for you every day. If you have any questions, give us a call, and we'll talk to you again in a month. Thank you very much.
Thank you.